Welcome to the deep dive. Today, we're putting a really highly regulated financial lens on assets you used to only see in museums or, ultra high net worth family collections.
Mm-hmm.
We're talking about masterpieces by Picasso, vintage Patek Philippe watches, and even entire luxury brands.
It's a huge shift.
We are diving into a whole stack of material on how the institutional world, so think pension funds, insurers, big family offices, is now treating blue chip art and high-end luxury as a true formalized investment category.
It's a remarkable transition, really. And the mission today is to unpack the legal architecture that's making all this possible. We're looking specifically at how fund managers are leveraging Luxembourg as the premier hub to formalize these strategies.
Okay.
The core objective is pretty powerful. Give qualified investors access to assets that offer uncorrelated performance and real tangible asset backing. And it's all housed within the most trusted regulatory wrapper in Europe.
And that wrapper is everything, isn't it? We're not talking about some informal collecting club anymore.
Not at all.
These strategies are structured using vehicles like the SCSp, RAIF, and SCA, and they're all sitting squarely under the European Alternative Investment Fund Managers Directive. That's AIFMD.
Exactly. And for you, the listener, that means these funds get full EU passporting.
Which is the institutional stamp of approval.
Precisely. That AIFMD compliance is what allows these very specialized assets to connect with huge global pools of capital.
Mm-hmm.
And they're using the same legal toolkit that a private equity manager uses for a billion-dollar buyout.
So you're taking the passion out of the portfolio.
And replacing it with process and governance.
Let's start with the universe itself. When managers are allocating serious capital, what even constitutes investable art and luxury? It's got to be highly specific.
Oh, it has to be. Managers need to prove two things: market depth and reliable valuation. For fine art, the key dynamics are limited supply, deep global demand, and the ability to find transparent pricing data.
Right.
So the sources really emphasize these blue-chip names artists whose markets have been institutionalized for decades.
Give us some of those names that provide that liquidity. What makes them suitable for a fund structure?
Well, you're looking at artists like Pablo Picasso, Mark Rothko, Jean-Michel Basquiat. They're the classic post-war and contemporary blue chips.
Okay.
But you also have the ultra-contemporary figures like Yayoi Kusama, Gerhard Richter, maybe even Banksy. The point is the fund manager isn't just betting on taste.
You're betting on trading volume.
Exactly. On reliable secondary market data from accepted auction houses. That's their valuation reference.
And their valuations behave differently, right?
Mm-hmm.
I mean, a Rothko holds its value because of institutional rarity, but a Banksy's appreciation might be more tied to, the cultural zeitgeist. The fund needs different due diligence for each.
That's a critical distinction. And the funds are often built to capture both the rock-solid, store value names and the high-growth contemporary market disruptors.
But art is only one pillar.
Right. The luxury market is the perfect complement to this exposure.
And how does luxury provide that diversification? It feels, less volatile than contemporary art, maybe.
It is less volatile because its value is driven by brand equity, by pricing power, and strict control over distribution. These brands actively manage their own scarcity. When the sources list names like Louis Vuitton, Hermes, Rolex, Patek Philippe, you're looking at entities that dictate their own pricing.
Okay.
They benefit directly from global wealth creation.
It's pricing power backed by legacy. So the manager's building a diverse portfolio across tangible collectibles like watches or classic cars, and maybe even luxury real estate concepts.
Exactly. They might buy a prime commercial asset and enhance its value by installing a curated managed art collection inside it. It's all about diversification across cultural asset classes.
This brings us directly to the jurisdictional choice. Why is Luxembourg the sort of gravitational center for this kind of strategy?
For almost any alternative strategy in Europe, private equity, debt, real estate Luxembourg is the default jurisdiction, period.
It's just the hub.
It is. It spent decades building the legal infrastructure and, crucially, the ecosystem of service providers.
But when you're dealing with assets this unique, a Basquiat painting, a limited edition watch, that stability and regulation have to be paramount. Why does the AIFMD framework matter so much here?
It matters because AIFMD is essentially a governance mandate and a passport system. Compliance means the fund has to follow strict rules on risk management, on transparency, on reporting.
And that's the EU marketing passport you mentioned.
That's it. It allows the manager to market the fund seamlessly across all 27 EU member states.
So if I'm a pension fund in Germany, I know that even though the underlying asset is a sculpture in London or a car collection in Geneva, the fund itself has this rigorous oversight.
Correct. The stability of the wrapper has to compensate for the inherent illiquidity of this.
Of the assets
Yeah.
themselves. The fund structure has to be the most stable, predictable part of the equation.
And Luxembourg provides that bedrock regulation. There's also a comfort level for investors.
Sure, if an institutional investor already has billions in Luxembourg real estate funds, adding an art fund is less intimidating.
It becomes another sleeve in a familiar structure, not some leap into an exotic black box. The due diligence team already knows the legal language, the depositaries, the auditors. It simplifies things massively.
And the tax side.
Well, the goal is always tax neutrality at the fund level. It ensures returns are taxed at the investor level, which is a huge draw for international capital.
Okay, let's dive into the legal engineering. This is where we bridge that gap between finance and, cultural assets. We need to get into the 4 core legal vehicles. How do managers choose?
It really comes down to 3 things: the target investors, the governance structure they want, and the tax flexibility they need. We basically move from maximum flexibility to maximum corporate governance.
Let's start with the most flexible one, the SCSP, the simple limited partnership. What makes it so popular for these new strategies?
The SCSP is huge because it mirrors the Anglo-Saxon LP model. It's a contractual partnership without its own legal personality. And crucially, it's got massive contractual flexibility, and it's typically tax transparent.
So the use case here is very specific, right? It's not for a huge public fund.
Exactly. Think of a sophisticated family office or maybe a small group of high net worth individuals. They set up an SCSP as a club vehicle to pool capital for, say, collectible cars and design furniture. They can tailor all the rules without heavy regulatory overhead.
Okay, so if we professionalize that, we get to the next level, the SCSP SICAV-RAIF. How does adding RAIF change the game?
The RAIF, or Reserved Alternative Investment Fund, immediately requires an authorized AIFM, an alternative investment fund manager.
And that adds that critical layer of oversight.
Instantly. It gives governance comfort to qualified investors, so you keep the partnership feel with carried interest and so on, but you apply institutional discipline.
And what's the killer feature of the RAIF structure for managing all these diverse assets like art and wine and cars all at once?
That would be the umbrella structure with compartments. A manager can launch one RAIF entity, the umbrella, and then create multiple ring-fenced compartments within it.
So compartment A could be German photography.
Compartment B is luxury hotels with art installations, and Compartment C is just vintage watches. Each one has its own policy, its own investors, all under that single AIFM umbrella. It's incredibly efficient.
Moving up the governance ladder, we hit the SCA SICAV-RAIF, the partnership limited by shares. When would a manager choose this more corporate structure?
They choose the SCA when they need stronger corporate branding. The structure uses a corporate general partner, which retains control, a lot like a typical private equity fund. It creates a stronger separation between the capital providers and the decision maker.
So this is designed to appeal to the big, conservative, institutional players.
Precisely. Pension funds, sovereign wealth funds, they're already investing in infrastructure and expect this familiar model. The SCA lets the art fund mirror the governance standards they already demand.
And finally, the most conservative option, the SA SICAV-RAIF, the standard public limited company.
The SA is the classic corporate fund. Governance feels completely traditional, clear separation between shareholders and the board. It eliminates all the partnership optics.
I'm guessing this is favored by institutions with really risk-averse compliance departments, like a major bank or an insurer.
Absolutely. If a strategy focuses on stable income like from luxury real estate or trophy hotels, the SA format is the safest pair of legal hands for the most conservative capital.
We've established the vehicle and the assets. Let's shift to the investment thesis. What is the simple, compelling rationale for investors who are used to just buying stocks and bonds?
The rationale is built on hard asset fundamentals. First, low correlation. These assets often hold their value when equities slump. Second, inflation protection. They're tangible, supply-constrained goods. And third, you have this unique upside that's linked to cultural trends and global wealth creation. The fund just formalizes that whole process.
So the investor isn't buying a specific Picasso. They're buying exposure to a professional platform that handles the sourcing, the due diligence, the custody, and the exit.
That's the entire value proposition. But here's the rub. Running these funds is incredibly operationally intensive. This is where you really get into the weeds, in the friction between finance and physical assets.
Right. It's not just booking an asset on a spreadsheet. When AIFMD mandates a Luxembourg depository for safekeeping, what does that depository actually do for a collection of vintage watches?
It's a completely different level of diligence. The depository has to verify the existence and ownership of every single physical asset. They monitor the title, check the insurance, confirm registration. For a painting, they might track its physical location as it moves between climate-controlled storage in Geneva and Singapore.
And that focus on title is critical. I mean, the AIFM and the board must be all over valuation governance, but also the documentation of provenance. What happens if cultural heritage rules apply?
That's a huge area of risk management. Provenance means documenting the entire ownership history to prove it was legally acquired and, legally left its country of origin.
So if a fund buys a piece that Italy or Greece might deem culturally significant,
Strict AIFMD protocols require the manager to prove all export and import laws were followed. They need specialists, art lawyers, historians to do forensic due diligence. They treat the asset exactly like a PE manager treats a factory. Every box has to be checked.
let's talk cash flow. Since appreciation is long-term and operating costs are high insurance, storage, when do investors actually see a return?
Distributions are inherently lumpy. Professional investors have to be ready for the J-curve effect, just like in private equity.
Okay.
You pay all your costs, insurance, storage, transaction fees in the first few years. That drives the initial downward slope of the J. Returns only show up much later, when assets are sold.
So you have initial costs, negative returns on paper, then a potential sharp upward curve years later when a major piece sells at auction.
Exactly. The liquidity is locked up. Exit routes are things like private sales to collectors, block sales at auction, or refinancing a luxury hotel where the art added significant value.
I do find the optional liquidity point interesting, though. The fund interests themselves, the LP shares, can sometimes be traded on a secondary market.
It adds a layer of professionalism. It's not guaranteed, of course, but the ability for an investor to potentially sell their position to another qualified investor makes these structures much more palatable.
So if we synthesize all of this, what Luxembourg has done is provide an institutional-grade chassis for assets that used to be considered too, emotional or illiquid for mainstream finance.
That's it. It offers managers a professional wrapper, a flexible strategy, absolute governance comfort through AIFMD, and tax efficiency.
This transition is just fascinating. Managers are taking the subjective cultural value of these assets and translating it into a highly disciplined risk and return financial allocation.
And they're using the exact same playbook and legal structures that govern global real estate and private equity.
Which raises an important question for you to consider as a listener. If this institutionalization is driven by the strict governance of AIFMD, does that governance change the fundamental definition of the asset itself?
Does treating a masterpiece purely as an investment, subject to a 6-year fund horizon and mandatory independent valuations, fundamentally limit a manager's ability to pursue true, long-term cultural curation? That tension between the regulated balance sheet and the priceless canvas, that's where the next chapter of this market is going to be written.